How should investors read the IMF upgrading its China outlook when it comes to growth to 5.4% this year, but they have their expectations for next year at 4.6%, a slowdown?
Well, the 5.4% for this year is a bit backward looking. We had better numbers out in the third quarter. And remember, there's some distortion still in here because last year growth was very weak. So the year-over-year comparison is quite easy. I think the bigger message here is that we're still looking for a slightly weaker number going to next year. Because the headwinds remain in place, particularly for the construction sector. It is such a big sector that unless you see a strong revival there, that's going to cap the ceiling or provide a ceiling for economic growth in China throughout next year.
All right, so we have some other headlines. Chinese imports, they unexpectedly rose 3% year over year for October. But I want you to take us beyond just the headline, because when you look deeper into the numbers, their imports from the U.S., they were actually down about 4%. And they were higher, 5% higher for the EU, and then 10% higher for other Southeastern Asian nations. What does that mean? How should investors interpret that?
Well, a couple of things. One is trade for China is already moving away from the United States. That's a multi-year process, and you continue to see that in daily data. But there's another issue here, and that is that China continues to import quite a large volume of commodities. Therefore, trade with other emerging markets remains strong, but is importing less machinery, less goods that the United States might sell to China. And so that's where you see this discrepancy at the moment. China still remarkably is using a lot of raw materials, record imports of copper, for example, but not machinery.
Is this also a read on U.S.-China relations and EU-China relations, the fact that we're seeing those imports decline from the U.S. but rise so sharply from the EU?
That may have something to do with it. Of course, we have tariffs that were imposed by the U.S. on China. We have seen Chinese companies buying fewer American goods. That's just the way things are currently developing. But on the other hand, there are also a lot of cyclical issues here. China is just broadly buying fewer goods. The dollar is very expensive, for example, so you'd expect China to buy less goods from the U.S., but more goods from Europe, which has a cheaper currency relative to the U.S. at the moment.
You're hitting on something else I want to talk to you about, the rising dollar. How is that impacting the broader economies of Asia? We mentioned that increase in imports from Eastern Asian nations to China, but in general, how are Asian economies right now?
Well, they're still struggling a little bit because the global trade cycle is down. Even despite the fact that we have a strong dollar, there are just fewer imports into the United States, fewer into Europe, fewer into large economies. So trade is still not really bouncing back. And the strong dollar, of course, reflects higher U.S. interest rates. And that's a headwind for Asia as well, because it raises the interest rate levels across the region. And that, of course, depresses domestic demand as well.
All right, I want to come back to that IMF headline. Again, the IMF raising its growth outlook for China to 5.4% this year, but 4.6% for next year. One of the factors for the lower growth next year is the property market. Give us a sense. What's your read on the Chinese property market? Is there a continued risk of contagion to other Chinese equities?
Well, there's the Chinese property market continues to struggle a little bit. We haven't seen really a pickup in sales just yet. The government has imposed some stabilization measures, but it will take time to fully gain traction. And it may be another year before you see really a full bounce back in construction, for example. So certainly for the coming year, it's going to continuously provide a drag on economic growth.
All right, so that's a drag on economic growth. How does that impact U.S. companies get a large portion of their revenues from China? We've been talking about it for a few weeks. Some of those companies, we're showing them to the audience right now, Yum China, Apple, of course, Elf. How are they impacted by this?
Well, the construction sector itself doesn't necessarily mean that other types of consumer spending should slow. We've seen, in fact, some improvement in consumer sales. And so there may actually be, if you're a consumer space, for example, there might be a gradual improvement over the coming year. Nothing super quick, but better numbers than this year. So it depends really the sector you're in. Consumers should do much better over the coming year.